Today we're diving into an analysis report called CGC, the fake out before the breakout. Rocket, why I'm not selling. It argues that the recent 12% drop in CGC's price is a classic market maker trap designed to scare off retail investors.
And it really captures that urgent contrarian feel, which I like. The whole premise is that they want your shares cheap.
Exactly.
But for this kind of analysis, you have to move from that great narrative to an argument that's, structurally airtight.
That's a really good way to put it. So let's start there. While the report establishes a compelling psychological framework by labeling the drop a market maker trap, the analysis would be strengthened significantly by integrating structural market data that empirically validates this interpretation.
Yeah, the weakness right now is that the whole story really hinges on this emotional idea. It's focused almost entirely on the price action hitting that $147 low.
And if that's all you're relying on, the argument is pretty vulnerable.
Vulnerable to what, though?
Well, a skeptical reader is going to immediately ask, how do you know this wasn't just a big institution taking profits?
Right, or just standard de-risking after a quick run-up. The drop to $147 could just be a coincidence.
Without that deeper data, it really does feel more like you're interpreting the price action rather than, proving that it was engineered.
Exactly. So the suggestion here is to bring in some of those complementary, non-psychological data points.
To prove that this was actually a targeted shakeout.
Yet that's how you shift the argument from just a persuasive belief to something that's backed by data, by structure.
So what would that look like in practice?
Well, a really concrete example would be to analyze the volume profile during that flush phase.
You mean that big, sharp move down from the 185 high to the 147 low?
That's the one. If it was a real stop-loss hunt, the volume should have a very specific fingerprint.
You wouldn't see just average, steady selling on the way down.
No, not at all. You should see these intense, sort of disproportionate volume spikes right at that critical 147 low, or maybe even just below it.
Because that would suggest aggressive buying, right? The market makers stepping in to absorb all the shares from the retail stops that just got triggered.
That's the structural evidence of the trap. That intense accumulation right at the point of maximum pain.
Without that volume spike, it just looks like regular selling pressure.
It does. And, to build on that, if you have access to the data, a quick reference to institutional flow or even just changes in the short interest ratio would be huge. If you could show data, say with increased short covering or heavy institutional buying around that 148 close.
Then the trap-detected thesis goes from a great narrative to a really robust, investigated claim. Okay, so that really nails down the need for tactical, structural evidence. But let's zoom out a bit to the engine driving this whole trade, the fundamentals.
Right.
The report correctly points out that the main catalyst, the rescheduling news in the U.S., is still very much intact.
And it lays that out clearly. That's the whole reason the dip is being framed as just technical noise.
But in part 3, the macro picture, it feels more like an assertion than an analysis. It just states, this was a price correction, not a fundamental shift.
Which brings us to the next point. A deep expertise analysis report needs to proactively engage with potential counter-arguments related to the certainty or timeline of that catalyst.
I see where you're going. The weakness is that by not really addressing those external risks, like, say, political delays or regulatory hurdles, the report feels a little incomplete.
Even if the technical setup looks perfect.
Exactly. Is there a risk that the market is starting to price in a delay?
That's the key question. A delay doesn't kill the catalyst, but it definitely impacts the time value of your investment. It tests the patience of capital.
The analysis needs to be sort of inoculated against that possibility.
For sure. The market prices in expectations, and that includes timeliness. If everyone thinks the catalyst is coming in Q2, but it gets pushed to Q4,
the price has to account for that. So the suggestion is to add a brief section that outlines those potential external variables that could cause a delay.
And then, importantly, explain why the analysis is still confident despite those risks. It adds a layer of nuance and it protects the core argument.
That's really actionable. So a concrete example would be, instead of just saying, the catalyst is unchanged.
You could briefly analyze the probability of, say, regulatory timelines shifting by a quarter or two.
Just acknowledging that risk makes the bullish conclusion so much stronger. It shows you've weighed the biggest macro headwind, which is time.
And you can even use that risk discussion to define a new support level, linking the macro picture right back to the technicals.
How so?
Well, you could explain that the $140 support level is valid if the catalyst hits within the expected time frame.
But If you start to factor in a major delay, say pushing it past the end of the year,
Then that fundamental pressure could push the price down to a much deeper level, maybe all the way down to the 52-week low at 0.77.
I see. So by establishing that context, you're anchoring the technicals to the fundamental clock. It manages expectations and defines the difference between a small pullback and something much more serious.
All right, so that brings us to risk management. This is absolutely critical when you're talking about a market maker trap.
The Monday Battle Plan section is pretty effective. It gives clear targets for accumulation, that golden pocket between 140 and 145.
Yeah, and the trade thesis itself is phenomenal. That idea of risking pennies to make quarters.
It's very compelling.
But if you're going to be that aggressive on the entry, you need an equally aggressive and precise exit plan. Which leads to our third point. The analysis requires a more explicit and tactical definition of when the core bullish thesis is definitively invalidated.
The weakness here is that the report says the downside risk is support around 140. It implies it's just a small 5-6% risk.
But the connection between breaking that level and the entire trap narrative completely failing is just implied. It's not laid out.
And that's a huge gap in risk management.
To a genuine structural correction.
That's a great point. If the market makers really did trap everyone at 147, why on earth would they let the price collapse below $140?
They wouldn't. A failure like that would prove the price drop was driven by something much deeper than just a stop-loss hunt.
So the suggestion is to explicitly define that line in the sand. You have to analyze why a break below that support would mean the whole thesis is wrong, triggering a tactical exit.
You're not just defining failure as a number, but as a confirmation that the thesis itself has failed.
And that clarity is essential. So, for a concrete example, you'd state clearly that the bull case is intact unless the price sustains a close below $140.
But sustained close can mean different things to different people, right? How do we define that?
Well, you have to link it back to the psychology of the trap. A single day closing below could still just be volatility. A secondary shakeout, maybe.
But if it can't recover that level, if it stays down there,
Then the very institutions that supposedly engineered the trap have failed to defend their own accumulation zone.
So I would suggest specifying the time frame, something like if CGC closes 2 consecutive trading days below the $140 support, the trap hypothesis is invalidated.
That second close confirms that the market accepts a lower valuation.
Exactly. It gives you a clear, non-emotional trigger to get out.
And linking that failure point back to the original risk-reward makes the whole thing so much more powerful. If the price is allowed to fall back and test the 52-week low.
The trade is no longer risking pennies to make quarters.
Now you're facing a catastrophic loss of all the gains since the bottom. Defining that hard invalidation point is what protects an investor from just holding on out of pure hope.
That kind of precision really elevates the entire analysis, from a great prediction to a professionally managed strategy.